Well, Quess Corp reported a strong set of numbers in the third quarter of financial year 2020, aided by its largest segment, that is the workforce management. Overall, the margins of the company also expanded compared to last year on the back of lower other expenses and the implementation of Ind AS 116. To give us more details on the quarter gone by, joining us now on the show is S. Ramakrishnan, the Chief Financial Officer of Quess Corp. So, sir, to start off with, your largest segment, that is the workforce management, has grown 52% compared to last year, but margins have contracted only for this segment. Can we expect the same trend to continue for some time going forward?
See, I think first of all, it's important to kind of put things in perspective, from an overall economy perspective. When, obviously the whole economy is going through a slowdown. Under those circumstances, the kind of numbers which were reported is, definitely an outlier. Having said that, from a margins perspective, there are two things which contribute to it. One is the fact that as we get into some of the larger deals, where, it's like one deal with the multiple, kind of employees being recruited. In those kind of cases, there is an opportunity where initially the margins could be lower. As we keep improving the suite of services which we offer to the customer and start adding more and more value-added services, then the margins get back to their original status. So that is a ramp-up phase of any customer, contract, number one. Number two, also, we need to see this is the festive season where what would happen is there will be a lot of cases where we'll have a pass-through. There will be a festivity bonus or a festivity incentive which is paid by the customer, which needs to pay it back to the employee. There is no margins, absolutely. So it will just push up the top line, but margins won't flow through. So that is, if you look at it from a margin percentage perspective, it will drop because you're looking at on a higher revenue base. So these are the broad two parameters, but otherwise, if you look at it, my workforce management group has reported about 52%, like you rightly said, revenue growth year on year, and on the EBITDA side, they've grown about 34%. I think those are stellar numbers, and the numbers talk for themselves.
Okay, tech services similarly saw a strong 19% growth, with operating margins nearly doubling compared to last year. What's aiding the strength for this segment, and what's in store for future when it comes to the tech service segment?
The tech services is kind of aided by, both the acquisitions, which is both, the Connect, which is the Tata Business Services acquisition, and the Allsec acquisition. One being in the voice-based services, and the other one being in the non-voice and the HRO services. Both the acquisitions have been fantastic. Connect, when we acquired, was doing about 50 odd crores of EBITDA. Today is doing about close to 75 to 80 crores kind of an EBITDA within about 2 years. That's a huge jump in about a couple of years' time. Allsec similarly on a quarterly basis does close anywhere between 18 to 20 crores kind of an EBITDA. Now these are numbers which have been growing consistently year on year. Allsec was not there last year, so this year that's a big addition. Apart from this, our other businesses like MFX has been doing well. QDG, after the Amazon investment, has been ramping up our service centers and again has been doing well. So tech services as a business is something which is growing well. This business we like also because of the fact that it also gives us much higher margins. We expect Connect Allsec also to continue the same trend, and so is the case with MFX.
Okay. So what is the update on Monster's operational metrics? Also, can you share with some details on the same, and how's it doing on the bottom line front?
Yeah, so Monster, if you look at it, has been, again, a good turnaround story, as we had committed to the market. If you look at it, we started the year with a Q1 loss of about close to 10 crores. We brought it down to about 7 crores in Q2, and in Q3 it's come down to 4 crores, and in Q4 we are probably looking at something in the range of about 1.5 crores. So, consistently the losses have been coming down on Monster. Having said this, from a product perspective, the beta testing is on, and the search engine is in a much better shape, and is giving some very strong results. Our yearly signals of the beta test is very strong. The job views have been consistently increasing in the job portal. The number of resumes being posted in the portal is also consistently increasing. So both the employer side and the employee side, we are seeing good traction. However, I think there are multiple steps to be taken before we start looking at numbers growing to the next level, which is basically the final testing of the remaining modules need to be completed. Post that, we need to make sure that parallelly we are getting the sales force ready, and then there will be a marketing campaign, and then you will start revenues start trickling in. So I think we are on the right path on Monster, especially from a product perspective.
Okay. Multiple surveys indicate that current hiring outlook is bleak. So how are you fending off this challenge currently?
See, in our case, what has happened is, we had a Q1 and Q2 are very, very strong from an hiring perspective. Of course, Q3, we added all in all about 8,000 odd people. But if you look at it, the year-on-year growth is about 26%. But when I started the interview itself, I clearly said that the economic conditions and the environments are not conducive. They are not very, very akin to business. So that being the case, obviously it's a challenging environment. So customers are thinking sometimes in terms of whether we should move forward or should hold on for it for some more time. And also similarly from a margin perspective, also customers are looking at how they could squeeze in margins under this tough circumstance. That's on one side of the story. The other side of the story is also some customers look at this as an opportunity to variabilize the cost. So whenever a customer is looking at variabilizing their cost, then Quess is right there because we have the whole suite of services, be it on workforce or facility or security or technology. So it's mixed bag. I wouldn't say that it's very positive or negative. I think it's a mixed bag.
Okay. Lastly, sir, what is Quess Corp's inorganic strategy now? Since you have acquired varied assets over the last 1 year, how are you integrating that into the business currently?
In fact, our last acquisition was in April 2019 with Allsec, and that came after a lapse of about more than a year and a half. So, we've gone quite slow, very honestly, in the last about 2.5 years on acquisition. It was only one acquisition. So we've not done any big acquisitions at all, and we don't plan to do any further acquisitions. So obviously what we are doing is the cash which the business is generating, we are going ahead and reducing our debt levels on a very, very rampant phase. So if you look at it during the quarter, we reduced about 90 crores. In the last 6 months, we reduced in excess of 400 crores of debt. That's also reflecting in our interest cost, which has also come down by about 6 odd crores during the quarter and is expected to go down further. Debt levels also will go down further because the cash we are generating, like I said, is not being invested in any fresh asset. That being the case, obviously, we're paying down our debts quite rapidly. So this is going to be the strategy of the company. Our strategy of the company is more in terms of consolidation, making sure that whatever commitments we've given to the market, continue to focus on that, be it on cash generation, debt reduction, OCF generation. I think those are the kind of simplifying our group structure. During the quarter, we reduced about 5 entities, compared to what we used to have. So simplifying our group structure. These are the broad themes, and we are working towards that as we continue to focus on our operational growth.
Well, that would be all, sir. Thank you for speaking to Bloomberg Quint.
Thank you.